Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, part 2, I'd like to talk about how to successfully invest in commercial property. Now, last week's episode, part 1, was all about commercial property fundamentals and attributes, and in particular how it differs from residential property. So the aim of that episode was really to give you a bit of an introduction towards commercial property so that you had a reasonable basis for then talking about how to invest in commercial property. So if you haven't seen that or listened to that episode, maybe go and do that now before you digest this episode. So what I wanted to do today is take you through different investment options, so how you can invest in commercial property, and that includes buying direct commercial property, so buying a building yourself, co-investing with others, or using what's called REITs, real estate investment trusts, which are many are listed on the ASX, but there's other managed funds and so forth. So another pooled vehicle, and I will talk through each of those. But before I do that, like I talked about last week, there's 3 categories of commercial property. Now, there's lots of different subcategories, of course, but if we're going to just put them into 3, the 3 would be retail property, like shopping strips, those sorts of things. Industrial property, which tends to have one tenant and be located in an outer area, so sort of industrial shed for a manufacturer or something like that, and office. An office, as obviously that the name explains, is an office building, typically with multi-tenants and so forth. So perhaps the best place to start is what I don't do or what I'm not particularly interested in at this particular time. And when I say at this particular time, because commercial property, unlike residential property is a necessity. We all need somewhere to live, whereas commercial property tends to be a little bit more cyclical and have a little bit more volatility. So it's quite possible that there'll be times that it'll be attractive to invest in retail property, for example, and there'll be times when it's not attractive. At this point in time, I'm not particularly attracted to retail property. Really what's going on, particularly with internet and online sales, is of course the retail industry has been under pressure in terms of margins and so forth, and that pressure either has to go on to profit margins as those businesses make less money, but I don't think that's going to be enough to compensate for the margin pressure that's gone on, and I think landlords will need to make some concessions as well. In particular locations. So, in terms of going and into a suburban shopping strip and buying a retail property, unless it's owner-occupier use, so you've got a business to put in there, and even then I'm not sure, but unless it's something like that as a pure investment, you're going to get a low yield, and, I'm not sure really where the demand's going to come from an investment perspective, and therefore capital growth in the future. And so that might change, but at the moment I feel like it's a bit of a risky sector in terms of valuation wise and future pressures. Industrial property, industrial property tends to have a higher yield, but my concerns are twofold. Firstly, they've got a single tenant profile, so that can mean that you've got longer periods of vacancy, 3 to 6 months, which it might be okay for some people in some portfolios, particularly if you already have commercial exposure, but something to really think deeply about. And secondly, these assets tend to have quite low capital growth. Unless you can buy industrial property in a gentrifying area, but doing that today, you've got to almost overpay to get into that market. So otherwise, then you're forced further out into a very, very much an outer area. And, unless you're going to buy in a corridor or some growth corridor or something like that, I think it's going to be difficult to get any meaningful capital growth. And so that leaves office, and I like office for 2 reasons. The first one is I've got tenant diversification. So an office building might have 20 to 40, 50 tenants in it. So the likelihood of all those tenants leaving their lease all at one time are really low. And so therefore, my income stream is a little bit more reliable from that perspective. And then secondly, you can add value to office buildings, or at least you've got far greater scope to add value to an office building compared to retail and to industrial. And you can add value in two ways. The first way is that you can make some capital improvements, and the aim of those capital improvements is to increase your rent per square metre. So those sorts of capital improvements that would be attractive to tenants is like refurbishing foyers, lifts, atriums, bathrooms, adding sort of end-of-trip facilities such as showers, bike racks, those sorts of things. Even fitting out offices, smaller offices ready for, smaller businesses and so forth, so they don't have to go through that fit-out process. All those things can go towards generating a higher rent per square metre, and that higher rent per square metre obviously then derives a higher end valuation. The second way you can add value is by improved property management. So that's really about having better and deeper relationships with tenants, so that tenants renew leases and are more open to signing longer term leases. And the key metric here is called WALE, weighted average lease expiry. And so the longer a building's WALE is, the lower its discount is, and therefore the higher the building value. And the reason for that, obviously, is a long WALE means that on a weighted average basis, the income is under lease for a longer period of time, and therefore that building looks like a lower risk. So if you can go and buy a building on a short WALE, and then get in there and start building some relationships with tenants by making some capital improvements to see that you're investing in the property, and you're going to treat them fairly and nicely and look after them, well then when lease comes up, they might be more willing to sign a longer term lease. And if you can do that successfully over a couple of years, you can potentially increase that WALE, and just that by that mechanism, you've then really added value to the building. Notwithstanding, you've still got sort of market exposure. So if market rents are rising or discount rates are falling or these sorts of things, it's also going to add value. Okay, so now that you know I'm in favour of office, if I wanted to go and invest in a commercial office building, how can I do that? Well, the first option is direct ownership, of course. You can go out and actually buy the building and own 100% of the building. And of course, the downside with this option is your limited budget. And it's going to be dependent on your borrowing capacity, of course, and the amount of cash that you've got or equity that you've got to contribute towards the purchase. But I would say that you need a budget of at least $2 million, I think, to buy a really good quality commercial property. And that's probably not going to be an office. Maybe that's going to be industrial. To buy a good commercial office, you're looking at probably substantially more than that. Of course, it makes sense that commercial properties sub 20 million, for example, there's a lot of self-managed super funds, wealthy individuals, etc., in that space, in that price point. And so therefore, because there's more buyers, the deals that you can get or the prices that you have to pay in that space aren't always as attractive. Whereas moving, say, between that 20 million and 80 million price point, it's too big for individual investors and too small for institutions. So it's a good kind of price point to get to. And I'll talk about shared ownership in a second. So one of the advantages, of course, of investing in direct commercial property is that you've got absolute control over the asset. So you can decide, who the tenant is, how long you're going to tenant for, and especially if there's alternate uses to that asset. So you buy it in an area that's gentrifying and then you can convert it to, residential or something like that. You've got full control in order to do that. Of course, if you're buying direct commercial property and your budget isn't substantial, it's like several millions of dollars, then it's likely you're going to end up with a property with one tenant. And if you have a single tenant profile, then you've got risks of longer term vacancy. And even if the vacancy isn't that long, you might have to offer tenant incentives, which means rent-free periods, So it's quite possible that, you don't receive any income for 6 months and so forth, something you need to really think deeply about. And now my wife and I have invested in direct commercial property and certainly enjoyed excellent returns. In fact, we sold that property about 18 months ago because we received a stupid offer. And it's my view that, commercial property that is at a price point where most of us can invest is selling for unusually high prices. And I just don't see the value as just a general comment at this stage. But as I said, commercial property can be cyclical, so it's not to suggest that sector of the market won't represent value. So I guess as a general comment, investing in direct commercial, I'm not particularly attracted to that because I think the prices being paid at this particular time are too high, and I don't really see where the returns are going to come from. Okay, which brings me to the second investment option then, which is called shared ownership. So it's possible to co-invest in commercial property with other investors, and these are often called investment syndicates or property syndicates. And it typically comprises of a group of investors that might go and purchase a building using some debt. So they might borrow 45 to 50% of the purchase price and then contribute the rest in equity. These assets are often owned in a unit trust, and each investor owns the units in that trust, so they've got a fixed entitlement. There's several commercial property investing businesses that arrange syndicates, and really, like anything in financial services space, you've got to be super, super careful. And in fact, I would say most commercial property syndicates really don't make very good investments. I mean, it's a little bit like investment grade residential property. Most residential properties aren't good investment prospects, and most commercial property syndicates also don't make good investment prospects. There's a lot to consider here, and the team behind the commercial property decisions is critical. They've got to have skin in the game. They can't be just employees willing to do deals and moving on. They've really got to have something on the line in order to make sure, give you comfort, at least me as an advisor, comfort that they're going to make good long-term decisions and they're not taking silly risks. And also, and probably even more important, they've got to have runs on the board, so a really good long-term track record of generating returns. Now, of course, if you find the right syndicate, it can offer heaps of different advantages. And the first one is you're leveling up on quality. You're really getting yourself into a price point that has far less competition. As I said previously, that $20 to $80 million price point, too expensive for wealthy individuals typically, and too small for institutions. So there's a lot less competition in that price point, and there's potentially better deals to be done as well. The other advantages are, the risk of suffering a lower income due to vacancies greatly reduced. If you have a large amount of money to invest, you can spread it across multiple buildings and get yourself some diversification there. And finally, the investment manager will manage the whole process, right through from asset selection, acquisition, negotiation, capital improvement, property management, and so on. So it's a very hands-off, passive style investment. And again, if you've got the right managers working for you, they're the ones that are really going to drive the returns and generate the value. Of course, the main disadvantage with this investment is that you own units typically in an unlisted unit trust, which is a illiquid investment. And so, of course, if the investment turns bad, if you buy the wrong property or something bad happens, of course, you can go and sell those units to someone, but who's going to want to buy a unit in a dud investment? So I guess, but that's true for most investments, I guess. Like if you go and buy a dud residential property, that's also hard to sell too, unless you really drop the price. But the way of mitigating that risk in terms of ending up with a dud investment is choose the right investment managers, so the people behind the business, and do your due diligence on the actual asset that you're buying as well. Make sure it makes sense. There's a evidence-based, rules-based approach to selecting that asset and understand where the returns are going to come from. So, if you can buy an asset at a very good price, you're happy with the type of asset you're buying, and thirdly, that there's plenty of scope for improvement, then the chances of making a loss are greatly reduced compared to, say, just buying something, on the basis that it's a rising market. Now, some people don't like co-investing because of the lack of control. If they can go and buy a residential property, they're used to being in control of that asset. Now, of course, I acknowledge that's a potential downside and people might look at it that way. I don't. I mean, if I go and invest in an index fund or an industry super fund, I don't control that investment, do I? But I can get my head around that. Well, same with commercial investing. I don't really want control, particularly in the commercial space, because I'm not an expert in that area. And in fact, I'm ultimately relying on the investment managers, the people that are making the investment decisions, to manage that investment and make decisions along the way. So giving me control doesn't really help me very much because I don't have the skill set to be able to take control of that investment. Whereas if it's residential property, it's far more kind of set and forget. And so having the control when you've got a residential property is not such a big deal because you can outsource the property management. And then beyond that, there's really not too much to worry about. So the lack of control in terms of investing in a syndicate, I'm far, far less concerned about from that perspective. And the final investment option is what's called a real estate investment trust, or REIT. They will come in a managed fund form or an ETF form. Those ETFs are listed on the ASX, Australian Stock Exchange, and they're a little bit like the pooled situation, the syndicates I just explained, but at a much bigger level. And instead of the units being unlisted, they're listed, so you've got a liquid market for them. REITs will typically invest in a number of buildings, and they could be worth, $500 million, whatever it is. It's a large pool of assets that they're managing. According to data compiled by S&P Dow Jones, about 60 to 80% of actively managed REITs fail to beat the benchmark. So therefore, I use exactly the same approach with investing in REITs as I do investing in shares. That is, I use low-cost passive indexing, not active funds management. And Vanguard has an excellent example that's produced some really good long-term returns. Now, I'm not surprised active management fails to outperform index. Some of the stories I've heard for, really large REITs where they'll have some acquisition managers that get hired, they'll go and buy a couple of buildings, they'll get paid a bonus this year and they're on to the next job. In a different role at a different firm. They don't really care too much about what the results look like, particularly over longer term. They've been paid and they've got their bonus and they've got no skin in the game. Whereas indexing, of course, is far more diversified and you tend to reduce your risk that way. I tend to avoid Australian REITs. I tend to go for international REITs just because Australian REITs have sort of too much exposure either directly or indirectly to retail property. And as a sort of sum up, I mean, whilst I certainly like REITs and use them for some clients, I like my preference is for the pooled approach, so the syndicates, when investing clients' monies and my own for that matter. Because I like the fact that we can go and buy a property, that I can understand the attributes of that property in terms of location, etc. So I can get some comfort there. And that, as I said, there's some value adds that you can implement to drive returns. And in fact, that you don't buy the building unless there are those value adds. So that is improve the management to increase the WALE and then to make some capital improvement to increase the rent per square metre. And so if there's those value adds as well as just general market sentiment that helps you, increases the building over time, then I think that greatly reduces your risk. Now, just to wrap up, of course, deciding to invest in commercial property without having a long-term plan is tantamount to asking for directions without a destination. You're not going to stop someone in the street and ask for directions. They'll say, "Where are you going?" "Yeah, I don't know." And, the whole point is having a long-term plan provides context, a context for deciding, is investing in commercial property a wise move at this stage? Does it help me get closer to my goal or further away? and that context is incredibly important. That being said, of course, commercial property is a wonderful investment. As I said, I've invested in direct commercial property. I don't hold any direct commercial at this stage. I've invested in a number of syndicates, which I continue to hold, and certainly help my clients invest in those syndicates as well. And it is a wonderful asset class that I do encourage you to consider, of course, if it's appropriate for your goals and age and stage of life. That's it for me for this week. Once again, thanks for listening. Bye for now.